this second episode of the Quiet Money podcast, I wanted to share with you how we ended up architecting this conversation between family offices, capital allocators, VCs, on the LPs and GPs perspective. Because too often on the news we hear about those great founders who raise hundreds of millions. But really, how do they get to that point? It's that secret that took me probably 15 years to figure out. And well, those people in that video are actually the ones, the mover and shakers that are deciding where the capital is going. So we have the chance to have Al Gore, yes, the former vice president of the United States, his own management fund and family office, represented by Colin le Duc, talking about how they decide on where to invest in. We also had one of my very life-changing partner, Dave McClure, who's got to be one of my first early investor in my company, literally 10 years ago. He wrote us the first check, and that completely changed our trajectory for my startup, because here we go, we're into Silicon Valley now, and we raised our seed round. So Dave McClure is on this panel. He's invested into more than 2,500 companies over the past decade and changed the life of countless people like me. And then we had other kind of more secret family offices, but also prolific investors in more than hundreds of companies. Nicolas Baz is one of the LP of Partech, one of Europe's largest VC fund, and you will have a chance to understand his perspective of making decisions on where to invest into companies, but also as a founder fund, how does he think and what makes him decide to invest in this fund or this trend rather than another one. Overall, we talk too much about the capital, but we don't talk about the mechanism that get people that capital, and this is how we wanted this panel to be architectured. I hope you learned something from this, as this is the time to raise money for the Quiet Renaissance. Enjoy.
Just a quick introduction about everybody here. This is a very exciting panel. Last panel we talked about from the start standpoint and also investing in climate. This whole panel is about allocating capital. And we're very, very honored to have these great speakers. I think starting from Colin le Duc is the founding partner at Generation Investment Management and Vice Chair of Just Climate. A true pioneer in sustainable investing, Colin has helped build one of the world's most respected climate-focused platforms, deploying sophisticated capital, private and public, that delivers both strong returns and meaningful impact. His long-term vision and deep expertise make him an outstanding voice on aligning capital with climate innovation. Yiwen Li is the head of venture and private investment at Bayview Development Group. Yiwen is a dynamic family office investor and operator with a sharp eye for frontier technologies, particularly surrounding AI, robotics, and blockchain. With a proven track record identifying high potential opportunities and scaling them globally, including Anthropic and OpenAI. That's $2 trillion right there. She brings fresh strategic insight into how patient capital can fuel the next wave of frontier tech breakthroughs and emerging fund managers. On the side, Yiwen is a jazz vocalist, so she has another performance at 6 p.m. today. Dave McClure is the founding, a legend, a founding founder of Practical Venture Capital and 500 startups. Dave is a Silicon Valley legend with over 30 years of experience as an entrepreneur, angel investor, and fund builder. Having backed thousands of founders and helped shape the modern early-stage ecosystem and recently expanded into later-stage companies. The AI wrote it. No. We look forward to having Dave share with us candid wisdom and observation from his unmatched track record and supporting ambitious builders. Nicholas L. Bass is a veteran venture capitalist and former serial entrepreneur with 25 years as a global tech investor. He is a partner at TechTown Ventures and senior advisor at Partech, where he was previously general partners, leading US and Asian investment. Nicholas has backed numerous successful companies and brings deep experience in early stage investing across the US and Asia. Thomas Hennessy is the president and managing partner at Hennessy Capital Group. Thomas is a highly accomplished capital raiser and investor who has sponsored 18 SPACs. That's quite a number. Raising over $4 billion with a focus on robotics, climate, and energy technology. Drawing on his experience at Abu Dhabi Investment Authority and global markets, he brings sophisticated insights on supporting late-stage, deep, and climate tech companies through the public markets. We have a great panel here. So the first question, first of all, the venture market has been somewhat slow outside of AI over the past few years. So what are the main trends and forces you are seeing from your perspective over the past 12 months, and what are you expecting over the next 12 months as the major trends and development that you are focusing on? Maybe starting from Colin. I know Colin has to leave a little bit earlier.
Yeah, thanks so much for having me. Sorry, the question was what are the last 12 months?
The last 12 months and next 12 months. What are you?
Yeah, I mean, I think for our firm, Generation, we focus on sustainable investing. And I think it's important to note that $2.3 trillion was invested in the energy transition last year, which is a lot of money. And it's a very significant number because it's the highest number in history. So I think what we're seeing is just an increased trend to more capital allocation to the energy transition, despite sort of headlines that might suggest otherwise. And I also think that it's increasingly the domain of highly specialized funds who can do that well from an asset management point of view, as basically the this is not, you can't just ride the beta trend, let's say, you need to really be able to understand the nuances. So what I think we see going forward is more capital to the global south, more capital that doesn't want to come to America, unfortunately, that wants to find other homes, and more, sovereignty and localization of investing, which basically around land transition, energy transition investing.
Great. Tom?
Thanks for having me, James. And I'm thrilled to be here. So where we focus is around three categories. So industrial innovation, clean energy, criticals, minerals, and mining. All happen to be incredibly topical over the past 12 months and what I expect to be over the next 12 months going forward. And as we saw in the panelists, the panel before us, panel number one, energy abundance, building reliable baseload power is squarely in our investment criteria right now. So we're spending a lot of time around clean energy. Specifically, the new next generation, Generation 4 small modular reactors, so SMRs. These are nuclear fission companies. There's a number of fusion companies as well. There may be some here today. We're spending a lot of time with those companies because they're building behind the meter power. And behind the meter power, as I'm sure you see in the headlines, is where the data centers are increasingly having to move. So they can't rely on the grid to power. So the hyperscalers, data centers, the large users of power, industry, they're going to need new forms of clean energy. And so we're spending a lot of time around that. And to give some support for why we're spending time here, there was a number of companies over the past couple of years that have gone public in this specific category. Probably the biggest name is Oklo, the Sam Altman-backed nuclear SMR business. But there's a number of others as well: NuScale, Nanonuclear, Terrestrial Energy, Terra Innovatum, and I expect dozens more are considering this path. And so that's where we play. We're focused on companies that are crossing the chasm from private to public, where they're ready. They aspire to be publicly listed companies, where they're capable of being public, and their internal controls are ready, and where there's investor support and demand. And so the regulatory environment is incredibly supportive for these type of businesses now. We've heard that on the last panel. The demand trends are there. And so this in particular is one area where we're spending a lot of time.
Great. Yiwen?
Thank you, James. I'm Yiwen. I represent a single-family office, both based here in Silicon Valley and also in Tokyo. So what I see in the past 12 months and what I see will coming in the next 12 months. So I have a tagline. So it goes like this. AI is the main party and the rest is just handover. I didn't come up with this. Claude wrote that for me. So what I see in the last 12 months is a lot of capital went into AI. Just to back that up with data. In the first 9 months of 2025, there are about 225 billion went into venture market, and more than half of that went into AI. For the non-AI portion, the venture capital space is still below the 2021 peak. And even within the AI space, there is a huge concentration. The top 5 companies raised 20% within the entire venture market. Of course, it's the OpenAI, the Anthropic. OpenAI and Anthropic, along those 2 companies, absorbed 14% of all the venture funding last year. So the trend that I see is within AI, the money first went to infrastructure, the data center, the energy, and then it went to the LLM, and now a lot of capital is in application and agentic. Now, in the next 12 months, what I'm very excited about, and I see capital went in, is physical AI. So if you think about AI as a kid, what it did is it read a lot of book, absorbed all the data on the internet in the past 3 years. All the data on the internet that could be trained for AI has already been trained. Now, the next 12 months, this kid growing up and want to go see the world. So the AI needs to sense, needs to see, needs to understand and interact with the physical world. That's what the physical AI and embodied AI is. So what I'm very excited about is specific foundational model for robotics. AI-enabled hardware such as robotics, advanced manufacturing, and advanced autonomy system. We're in this amazing aircraft carrier. The advanced autonomous system, also referred to defense tech and dual use. You probably all heard of Anduril, Seratic. Because we're in such an uncertain geopolitical world, I think dual tech and defense tech for the next 12 months is also very interesting. The last category, as the other panelist was talking about, is energy. I think we're in a very critical stage of energy because on the supply side, because of the war, the supply is tightening. On the demand side, the demand from AI for energy will not stop. So we're also looking at energy tech going into the next 12 months.
Great. Yeah, you can hold on to it. By the way, AI also has hangovers. You probably experienced that before. Nicholas.
Yeah, so I will give, so we're a family office with our roots in venture, and we do 2 things. We invest directly at early stage, and we also invest in emerging managers. So I'll give you the 2 perspectives, actually, in addition to what's been said. On the emerging manager side, what we look for are people, new managers who bring a fresh perspective to imagining the future, because we think it's a time for reimagining, and AI provides this unique opportunity to reimagine and reinvent a lot of things, and it's not necessarily optimal doing it the old way. So we like to invest in people who are very smart, who have a new perspective, and who are going to see things that maybe the older crowd, and I'll include myself in that, doesn't necessarily see. Right? On the direct investment side, I think the trends, I mean, we always hate this question as investors because we're getting ask that every time, and we never really know. Either we know and we don't want to tell you, or we don't really know, and honestly, we don't know. We shouldn't know, because the entrepreneurs are the ones who know. If I knew, I should be an entrepreneur. But more seriously, I think the AI infrastructure is being built, has largely been built, will continue to be built, and is this amazing utility. And so to me, the trends, it's not one trend, it's multiple trends in terms of where is this going to be applied? How are we going to apply this new energy, which is this compute and intelligence energy, to, how we build things, how we practice medicine, how we practice law, how we organize our businesses. And that's a really hard problem, because the utility itself does so much already. And that's, but those are the trends that are going to make the next big companies in all these different areas. But it's a hard problem, let's be clear.
Great. Dave?
Can people understand or hear what we're saying? I feel like I'm like Miss Othmar in Peanuts, like wah, 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 like the feedback is really fucking hard. I feel like I have nothing useful to say about this. Everybody's like talking about AI, like teenagers talking about sex, as if everybody's doing it and it's perfect, when the reality is most of us are not doing it. It's incredibly imperfect. I've been investing in companies for about 20 years. I would say it's harder than ever as an investor to figure out how to make money. Not to say that I haven't been successful with my investments in the past, but right now there's an incredible concentration of capital into a very small number of companies, as if that's the only way to invest. And I don't think that's really true. Both in terms of early stage investment, there's a lot of people who are not getting capital because they're working on interesting problems, but they don't have the words AI in their business, or they've added AI when it's not really AI, which is just a bunch of performance innovation bullshit theater, and has only inflated the price of capital by about 3 or 4 times. So like, as an investor, most of the conversations I have with startups are like, you're full of shit, the price is way too high. And a small number of them are really worth it, but most of them are not. And the same thing is true on the investor side. We're also doing a bunch of innovation bullshit where we're like, oh, we're investing in great companies, and yes, I was an investor in Canva, and an investor in Solana, and all this other shit, but like 90% of the things I invest in fail, which has been true for the last 20 years. So the one thing I would probably suggest you all realize is that we're all lying constantly. The reality is much less exciting. However, the tools themselves are more exciting than ever. I really think it's an amazing time to be an entrepreneur. The tools we have at our disposal now are magnifying productivity dramatically. But we all talk about it as if, like, we're all like billionaires making shit tons of money, and it's not very accurate. I'm investing in probably the least sexy and most boring part of the market, which is secondary investing, not in the top 20 companies. We try and find things that aren't on everybody else's radar, where we can buy at an incredible discount. And I know that's true because I've been a seller of those assets and faced the challenges of trying to find liquidity for illiquid assets when they're not SpaceX, Anthropic, or other things. So we do weird stuff like investing outside the top 20 to 50 companies, but still companies doing more than 100 million in revenue and growing. And for small sellers, that's founders, early employees, or early investors, it's difficult for them to get liquidity. Not to sound like a vampire, but that's a great advantage as a buyer to be able to get those assets. We do unusual things like invest in Latin America secondaries. Again, not on everybody's like sexy radar right now. So I would say that venture capital is still an incredibly challenging asset class, illiquid as shit, very unpredictable. Even late stage, we're freaking out about whether companies can sustain their advantage due to AI taking away a lot of margin and a lot of competition. A company like Canva, which I'm an investor in, doing $4 billion in revenue, growing at 30-40% per year and profitable. I freak out every day that like Anthropic's going to release a product that's going to like, cut that company's market cap in half or make it zero. So I don't know, it's a very confusing time to be an investor. I think it's a tough time to be an entrepreneur because a lot of capital is going into just a small number of ideas when there's a tremendous number of interesting ideas, but they may not fit the venture thesis, which seems to be becoming more and more narrow, which is really a shame because there's a lot of great people and a lot of great ideas out there, but not as many of them are getting funded as I think was the case maybe even just 5 years ago. So how's about that for optimism? Sounds like a terribly depressing scenario, right? Anyway, it's a fun place to try and make some money.
Thank you. Always amusing, Dave. Colin, I want to catch you before you have to leave earlier. You've been a real pioneer in climate tech before there was a climate tech. How are you seeing climate and clean energy sectors overall today, given the macroeconomic and political movements and trends today? And do you think climate transition, energy transition, is still on track? And how are you positioning generation to accelerate that shift?
Appreciate you bringing it back to climate. This is Climate Week after all, and a lot of panels seem to be talking about AI incessantly, and there's something bigger than AI, which is climate change. And I think one of the interesting things, as far as I'm concerned, and increasingly our LPs are concerned, who are really big institutional LPs primarily, but we work with a lot of different types of LPs, but primarily large institutions and sovereign funds, is that they've shifted from worrying about how to capture the alpha from the climate opportunity to worrying about the quality of the beta. So what I mean by that is they're worried about the systemic risk in the market from climate change. And so if you think about just a very immediate moment right now with the Straits of Hormuz being closed, the lack of fertilizer exports from there has meant that Ethiopia has just missed its growing season, planting season, okay? So they're going to miss an entire year of food supply because of the lack of fertilizer in that market. So that is the manifestation of a risk, right, of a systemic risk. If you look at a very explicit climate risk in this state, the retreat of insurance companies from the housing market means that basically your home prices in California are structurally too high because they basically will no longer be insured. And what is happening, and therefore you're not going to be able to get a mortgage and you're not going to be able to buy a house. And what's happening is that is starting to manifest. And what happens here in California is that the housing insurance retreat means that the state needs to take on, is the backstop for the insurance industry backtracking. And what that means is that the money that's being spent on insuring people's homes is no longer being spent on other things in the state, such as healthcare or education. And so these are systemic risks that are starting to manifest due to climate risk. I'll just quickly say one other thing. You all know the emissions chart, right, which just keeps going up and up and up and up, right? And we are at record emissions again this year. We're at record temperatures again this year. We're at record losses for insurers this year. And the year that it went down was COVID, where emissions growth went down 5%, but it just went straight back up after COVID. And if you want to reach a net zero position, we need to go down 7% a year, so more than emissions went down during COVID when the global economy was stopped, every year between now and 2050. That's obviously not going to happen because people aren't going to shut the global economy down. So what does that mean? That then means that the likelihood of us going to a 3-degree world is going up and up and up every day. So the best institutional investors in the world understand this systemic climate risk. And while I love being in California, the techno-optimism around rifle shot solutions around technologies, climate tech, is just, it really frustrates me because solving the climate crisis is a lot more than just these rifle shot technologies, wonderful as they are. And the other thing I wanted to say is kind of echoing what the guy was saying earlier, is one of the things that happens in the venture community, we're not venture capitalists, we invest a little bit later stage, but this happens later stage as well, is that people celebrate raising money. What is really important is actually how much money you return, not how much money you raise. And so I think people just need to kind of remember that, because I'm much more interested in the returns rather than how much a company has raised or a fund has raised, because there's a lot of zombie companies out there, there's a lot of zombie funds out there that are basically never going to return anything.
Should we be more concerned about the customers being satisfied and making profit? Like I agree with you, but I think profits and customers probably before returns, don't you think?
Yeah,
right.
Yeah, I think you're right. I'm sorry, so last thing I'll say, I'm so sorry, I need to run. The schedule's a little bit behind schedule, so I'm just going to walk off stage, not because I'm incredibly rude, but because I've got to get back into town quickly. So you asked me, how is generation positioned? So what we're doubling down on deep decarbonization, notably in industrials and in the highest emitting, most off-track sectors. We're the biggest investor in a green steel plant in Sweden. That's a 10 billion euro project that's fully decarbonizing the steel industry, for example. And we're doubling down on the global south. So we've just announced a Latin American regional platform to basically focus on nature-based solutions and industrial solutions in Brazil, Colombia, Mexico. And so we're trying to go where capital is not otherwise flowing. And as a specialist platform, we can do that because those risks are usually people just run away from, and they go to AI or they go to whatever they're doing. And so, again, like most of the money that's being raised and invested right now in all the hot hype stuff and the momentum stuff will never be returned. And that's just, if you look at the history of investing, that is just the truth. And we are long-term investors. And I think a word of caution for asset managers is, one of the things that we always try to do is just know what you're good at and focus on that and be the world's best at that. Don't stop trying to capture all these quick momentum things. We're not momentum traders. We're long-term investors. But I really appreciate you bringing it back to climate. Thank you so much, James.
Thank you, Colin. And give Colin a big round of applause. He's truly a legend, and appreciate his contribution to the whole community. Now, I really like to because we talk about a lot of depressing stuff, and I think one of the things about, I think Yiwen said, I think you said it best, this is the easiest time to start a company, but hardest time to defend. So I like everybody here to talk about what are the things that you're looking at in a company today versus, say, a few years ago, right? What are the things that you want to see to be defendable, to be fundable and defendable? And let's go from there. And I think, Yiwen, you can get started.
So I want to do a little bit of extension on the best time, the worst time. So I don't have a technology background. I studied English and German literature as my background. And one of my favorite authors is Charles Dickens. And his favorite quote that I have is very relevant to our era of AI. He left, so I can talk about AI. So it goes, it's the best of time, it's the worst of time. It's the age of foolishness, and it's the age of wisdom. It's the spring of hope, and it's the winter of despair. So to parallel that to our era of AI, it's the best of time to create a company because everyone can have access to OpenAI, Chat, to Claude. The technical barrier is really no more there. But it's the worst time to defend your company because everyone can do the same. Everyone have access to the same technology. It's the era of wisdom because the cost to knowledge is almost zero. You can ask Claude, ChatGPT, anything, and they give you a great answer. But it's also, knowledge doesn't equal to wisdom. So I think wisdom is more rare to find in the era of knowledge being zero. And lastly, it's the hope, it's a spring of hope. I think we really do have a hope of universal high income, but it's also the winter of despair because we might become obsolete because how fast, how better AI becomes. Bring that back to your question. What are the defensibility I'm looking at when invest in a company? There are three things. One is not technology. The first one is distribution. Because when it is easy to build a product, who can sell the best becomes an edge. So distribution is important. Go-to-market is important. Second is data. As I just mentioned, all the public available data on the internet has already been trained, but there are data behind the walls within corporation, within certain industries like biotech data, healthcare data, education data. Those data specialized data can be trained becomes another edge. So data loop is the second. The third one is talent. And I think what goes with talent is capital. Why do people raise so much money? Because it's very difficult, very, very hard, very expensive to hire top talent, AI researchers, people who understand whatever AI is doing. Also, energy is very expensive. I think that is why Anthropic, OpenAI, all this company raise so much money, and that becomes a defensibility as well.
Great. Nicholas?
Yeah, so in addition to all the great stuff we've always been looking for, great entrepreneurs, smart people, determined, etc., I think that there's three things in my view. One is, I think what's different about the AI context is that it creates all these blank sheets of papers everywhere. This is really a time for reimagining an industry, reimagining the way we do things, not just incremental thinking and improving. And so when I hear a pitch, the reaction you want to get from me as an entrepreneur is not, that makes sense. It's more like, that sounds nuts, right? I'm much more interested if that's the reaction I get, right? Because otherwise, it's by design, it's just going to be a very time-limited opportunity or business. The second thing I'm looking for as a sign of that as well is an ability to draw a long-term picture and roadmap of how they imagine the future and how it's evolving and the roadmap, and that translates in the roadmap for the business and the product and so on. And if they don't do that in a compelling way, that actually means they haven't even thought about the defensibility of their own business, right? And then the third thing is, from a more practical standpoint, I need to hear a more compelling story about what's of an execution edge that they bring to the table, and that could be very unique, powerful partnerships. It could be a very compelling way of reimagining a workflow because of their unique understanding of a specific industry, and so they're a compelling story behind, yes, we're going to build the best product that's most likely to be adopted in whatever industry. So execution, a compelling execution edge, ability to reimagine, and a long-term plan.
Great. Dave?
I'm sorry, what was the question that we're trying to address?
What do you think are...
I
it's
feel like we're kind
contrary
of
to
like
what you
covering
believe,
a lot of different
so you have
territory.
to be positive about it. Okay.
I would say I've become a much more conservative investor in the last 5 to 10 years. I used to do a lot of early stage investing, 200 to 400 companies a year when I was running 500 startups, and we did that in pretty much 75 countries around the world. As usual with most early stage investing, everything fails. About 2% of it works out fabulously well, and that offsets the rest. One investment that I made in Canada 13 years ago for $100,000 will probably return more than 200 million. I'm not saying that still doesn't work, but it's a long time to wait for returns. And there's a lot of dead bodies around for the things that don't work. So in latter years, both because of AI and also because I'm getting older and lazier, we've started investing more towards the later stage companies that are within 3 to 5 years of an IPO or an exit event. And this doesn't really sound as exciting as all the other stuff that's going on, but there's a lot of challenges for people who have been working at companies for 10 years that are still not liquid yet. both investors and employees. And so we found an interesting opportunity in the market and buying positions of $1 to $3 million, generally below $5 to $10 million. And that's from founders, from early employees, from investors, and also helping smaller LPs and funds get liquidity. As all the attention has gone to just a small number of companies that are doing fabulously well, it's actually become harder for the rest of the market to get liquidity. And so, again, it doesn't sound like the most exciting thing, but we've kind of shortened up our horizon. We're looking for things that can exit within 3 to 5 years, and the assumptions now are that the public markets require $500 million in revenue to go public, sometimes $1 billion in revenue. That really cuts down on what early stage is for me. Early stage is now $100 million, $50 to $100 million in revenue, which is usually Series C or later. But you know, there's probably 100,000 people in the Bay Area who have $1 to $10 million of equity in companies that might turn into real money, and those people can't buy a house in the Bay Area, which is usually at least $2 or $3 million. Myself, this sounds like a very high-class problem. About 5 or 6 years ago, I had to buy a house with $7 million in cash because I couldn't qualify for a loan to pay for that house and then get a mortgage after I bought the house. Which is kind of like the weird-ass fucking thing to be complaining about on stage here. But I had this seller issue. I had, like, you know, I won't mention a number, but, like, you know, at least 8 figures worth of what I thought was valuable assets, and it was difficult to find someone who would buy or help me, you know, lend against those assets to buy a house. So this sounds like a weird problem that's a minority of people, but it's really a $100 billion or more size problem in, you know, just the Bay Area, and around the world it's probably another 5x that. And so again, I kind of get back to like what's interesting to me these days, what's defensible is like going after strange and unusual problems. And so like something we're trying to do in Latin America is build a $10 million pooled secondary vehicle, not at all on almost anybody's radar that I would talk to, but a really big problem for people outside the Bay Area is getting liquidity against those assets. I think in terms of figure out like what's defensible, it's still going to be people with domain knowledge. It's probably going to be things that have some amount of proprietary data access or models behind them. But what's strange is that we used to focus on SaaS businesses that were almost purely software as being most capital efficient and most likely return capital. And now it's like, oh, we have to find something that's connected to the physical world that AI can't disintermediate right away. So it's like we've kind of reversed that whole logic. We're an investor in a company in Latin America that builds motorcycles, lends them to drivers on leases, and gives logistics jobs to those drivers. It's like a DoorDash plus, you know, a lending company. AI is not going to disintermediate that business. It's doing over $200 million a year in revenue. It's growing at 60, 70%. It's super profitable. Not on anybody's fucking radar in Silicon Valley, but it's a great company, and we got a really awesome opportunity to invest in that company a few years ago. So I would tell people, like, you know, defensibility is kind of in the mind of the beholder. Like right now, everybody's like, oh shit, anything that's software is going to get disintermediated. And I'm like, that's not really true. But yes, there are things that are vulnerable to AI. But access to proprietary data, access to a regulatory environment, physical bits, connection with humans, at least right now. We'll probably get soon where we will be able to fool humans, but can't completely fool humans with AI just yet.
Great. That sort of echo what Yiwen was saying about physical AI and distribution, right? I mean, that's not going to change. Tom, I want you, I mean, you are the sort of public market voice here. Like you talk about, you talk about the interest. I mean, what are the sectors you guys are more interested in now? But what are the defensible and foundable companies these days, in your view, that are ready to go public? Ready to go public through IPO or SPAC? And maybe talk a little bit about, you know, the difference in terms of, you know, the company's profile that should choose IPO versus SPAC.
So we have a long list of investment criteria, but what I will agree with my fellow panelists down at the end there is people make up organizations, people define the mission of those organizations. People set the vision for those organizations. People set the values for those organizations. So we're focused on people, and I think at the end of the day, that's defensibility. And yes, AI will substitute to some degree, but at the end of the day, we invest in people, very simply put. So we spend a lot of time understanding the aspirations of management, understanding the capabilities of management, and helping them with the resources, surrounding them with the resources and the talent such that they can then go execute on their aspirations for their business plan and their mission. We always start every presentation with mission, vision, values. As an investor, that might sound strange, but that we present that to other investors, we present that to founders, we present that to service providers. Because again, at the end of the day, it all comes back down to people. So SPACs, 1 minute, because I see the time's up. Board there.
It's okay.
IPOs have been fewer and far between, and they're serving much larger businesses these days. That's readily evident in the data. You can ask any investment banker about the data. If you ask an investment banker about what size business they would actually consider taking public, most often the answer is $2 billion of enterprise value and up. So what happens to everybody below that? There's really not a market for those companies. And so what we do with SPACs is not competing with IPOs. I often get that question from founders, and I say it's not a competition. It's really about, is it available to you? If the IPO is available to you, then pursue it. If it's not, come talk to us. So we service companies 500 million to 2 billion in enterprise value. There's a lot of businesses that are in that size range that deserve to be public, that deserve access to lower costs of debt and equity. And the longer profile, there's some VC investors here. The funds have been longer dated than ever before. PE funds, VC funds, hold periods, and there isn't enough liquidity, monetization opportunities for those companies. And so we provide that service and that partnership for companies.
Great. I know we have, time is up, but I want to have the panelists talk about one thing. If you can make one investment today, one geography, one type of sector, one stage, what is that investment? Dave? I guess you already said it. the motorcycle renting business.
People with valuable equity who have a hard time finding a buyer, but off the beaten path. Manufacturing automation and robotics, not humanoid robotics, but just how do you automate a factory faster and better? Again, sounds like an unsexy thesis, but there's tons of manufacturing and factories out there that are not automated, and we have a lot of innovation happening in robotics that can be applied to that. It's kind of overlooked, but probably a category that's pretty big.
Yep. Nicholas?
Okay, I'm not sure that's the exact answer you're looking for, but I would love to find a company that has a compelling answer to the problem of educating our kids in the age of AI. I have not yet seen any compelling thesis or solution to that problem, which I think is going to be essential.
Great.
So the geography would be here in Silicon Valley. I heavily drank the Silicon Valley Kool-Aid. The stage, I think the seed, pre-seed, Series A is no longer, I think Dave mentioned, it's no longer matters. So for me, it would be post-pilot, pre-scale, whatever that stage is. The sector would be physical AI, both robotics, advanced manufacturing, and the brain of those hardwares.
Great. Tom?
A real example, One Nuclear Energy is a company we're bringing public on NASDAQ, should close the next this quarter, actually, Q2. They're an independent power producer serving large-scale energy parks, natural gas to nuclear transition. So that is a real-time example of where I started at the beginning of this panel around clean energy and building reliable baseload behind-the-meter power.
Great. Thank you. Well, time is up. Feel free to mingle with the speakers. Thank you very much. Great job.